Hello everyone. We recently had a video on the basics of equity. Today we'll be going over an extension of that topic, which is treasury stock. We'll be covering everything from what treasury stock is, to the journal entries, and even an example. But before we do, please subscribe so you don't miss any future content, and comment with any questions or topics you want to see covered. I'd like to announce our first affiliate program. Planetwatch is a new crypto project with some similarities to the Helium project. This project has devices that monitor your air quality and rewards you in crypto. They want to improve the air quality for the world. Do some research on the project or reach out to us for any questions you may have. Our affiliate is realllygreatair.com, and they have sensors available now or for pre-order and can ship in under 48 hours. Some people are waiting months for these, so this is a great opportunity to get in and get a Kytera SenseEdge Mini now. Check out our description below for a link and a code for $50 off your purchase of a Kytera product. Okay, so let's get into the topic. So what is treasury stock? Treasury stock, also known as treasury shares or reacquired stock, is defined as a previously outstanding stock that is bought back from the stockholders by the issuing company. The result is that the total outstanding stock in the market has decreased. Let's visualize that action. Let's say Company A sells 1 million shares to the public. Then, at a later date, decides to buy some back. Let's say it's 100,000 shares are bought back. This means there is only 900,000 shares outstanding in the market. The company effectively re-owns those shares. You may be asking, why would a company do this? Well, there are 5 main reasons. The first reason may be for reselling them. This could be to pay for investments, acquisition, or even to give to employees as part of a compensation plan. Effectively, the company has bought them back to utilize their value. The second common reason is for controlling interest. This action can reduce remaining shareholders' interest in the company. This may be done to prevent hostile takeovers, for example. The next reason is the undervaluation of the company's stock. If the company sees their stock is undervalued by the market, the best way to increase shareholder value may be to use extra cash to buy treasury shares, making the remaining stock outstanding more valuable. The company may earn a profit doing this by buying their shares when the market is low and selling them when the market recovers. The fourth common reason is retiring of shares. This can be done for most of the reasons previously discussed, but the difference is upon retiring the shares, they are permanently taken out of circulation. The last common reason is for performing financial ratios. Let's say a company has a debt ratio that is either return on assets or return on equity. Both of these type of ratios would be improved by buying treasury stock, which might be just enough to avoid default. Okay, so some features of treasury stock are that they do not participate in dividends, they are not part of earnings per share or EPS calculations, and they do not have voting rights. So now that we know more about treasury stock, let's get into the 2 methods of accounting for treasury stock allowed under US GAAP. These methods are 1, the cost method, and 2, the par value method. We will note that both these methods are allowed under IFRS as well. The first method is the cost method. Under the cost method, the purchase of treasury stock is recorded by debiting treasury stock account by the actual cost of the purchase. The cost method ignores the par value of the shares and the amount received from investors when the shares were originally issued. Okay, let's do a quick example of that method. Let's say a company issued 10,000 shares with a $1 par value for $55,000. Then that company purchases back 1,000 shares at a $6 per share value. Then they resold 500 of them for $7. The entries would look like this. You have your issuance, the debit to cash for $55,000, and a credit to common stock for $10,000, and a credit to additional paid-in capital for $45,000. The repurchase is a debit to treasury stock for $6,000, and a credit to cash. Now, the resale. You would debit cash received for $3,500, and a credit to treasury stock for $3,000, and a credit to paid-in capital for $500 for the increase in value. The other method, the par value method, holds the treasury shares at par and adjusts through additional paid-in capital for the difference paid for those treasury shares. So let's keep the same facts as our previous example. So for issuance, it looks the exact same. For the buyback of 1,000 shares, it would just be the 1,000 shares times the $1 par value. So the debit to treasury stock is for $1,000. Additional paid-in capital is the 1,000 shares times the difference between the original issuance price of $5.50 and the par value of $1. So that is $4,500. You also do a credit to cash for $6,000 for what you paid. The difference is a debit to $500 to Treasury APIC. Now for the sale of the 500 shares for $7. Debit cash for $3,500. You want to credit Treasury stock for $500 and your APIC Treasury for the remaining $3,000. Clearly, this method is a little bit more challenging. So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. Alright folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.